Cost center accounting isn't complicated, but knowing when to introduce it is. If you get it the cut timing, let's start again. Cost center accounting isn't a complicated, but knowing when to introduce it is. If you get the timing wrong, you'll either slow the business down or you'll miss what's really driving the costs. In this video, I'll show you how to judge that timing properly. Hi, my name's Alysha Randall. I'm a fractional CFO and I'm also the author of Financial Leadership Fundamentals, How to Become a CFO in a Startup, a Scale-Up. Cost center accounting is one of those topics that might sound technical, but the real issue isn't mechanics. It's not how you do it. Most finance leaders know what cost center accounting is, but the harder question is when to introduce it and how to do it without creating noise, wrong behaviors, and even bureaucracy. So done well, it can materially improve decision making with a growing business. Done too early or implemented badly, it can really slow teams down, distort focus, and create unhelpful internal politics. Before we go through cost centers, there's one really important point to make, and this is something I'm quite strict with my leadership teams, is that your leadership team has to take ownership of the entire P&L. If they don't, then potentially introducing departmental cost centers is premature because then they will just focus on their own cost center. So you really want a leadership team that is working together to make the entire P&L as good as it possibly can be. And you also want them to feel ownership of the P&L. It's not something that you as a finance person looks after and it's got nothing to do with them. You really want them to take ownership. And that takes a bit of changing the way that you talk about the P&L with them. It's subtle changes with languages, subtle ways of getting them on board. So it might be having one-to-one meetings with all of your business partners, with entire leadership team, making sure that they understand the P&L, and if they don't, helpfully explaining it to them, and then making sure that they do feel ownership of that. It's often easy to do that during a budgeting process, because you're taking them along for the ride and they feel like this is the P&L that the company wants to deliver. But until you have that, you don't want to introduce separate cost centers. So what does cost center accounting actually give you? So at its simplest, it just helps you understand where the money's being spent. So it groups costs into different departments so that you can give you a bit more insight. So it might be separate into departments or products or channels or projects. It really depends on your business. So FMCG, for example, fast moving consumer goods, may do it product-based cost center reporting rather than departmental. Whereas, say, a fintech or a SaaS business, they may very much do departmental, or you might even do regional and departmental or a combination. So it depends on your business. But in theory, it gives you more insight. But in practice, the value, as I said, really depends on how mature the business is and how mature the leadership team are. So for growing companies, cost center accounting can really answer questions like, where are we actually spending our money? Which areas are becoming cost heavy? Are certain products or channels subsidizing others? And those are really useful questions, but they're only useful if people are interpreting the data properly. So product segmentation versus departmental segmentation. I did kind of mention that it's very useful with different business models, so FMCG versus fintech, for example, but there's also a way of introducing both of these depending on where the business is in its life cycle. This is sometimes also where businesses can go wrong. So product or revenue segmentation is valuable early on, even when you don't have a leadership team at all or a leadership team that owns the P&L. So there's a slight nuance. And the reason for that is because most product teams work on all products. Most operations teams work on all products or services. Most marketing teams work on all products and services. So putting in that product segmentation early on may not affect the leadership team, as I strongly indicated at the beginning. And it's also incredibly important at that early stage because you want to understand which products or services or channels are generating the strongest margins. And that is quite critical when your resources are tight. It helps leadership decide where they should be focusing their money and their effort. So if you can clearly see which products drive margins, which channels are expensive to serve, and where the contribution is the strongest, then you can make better decisions about growth. Departmental cost centers are very different. So smaller or less experienced leadership teams introducing departmental profitability too early can create problems just because leaders will start optimizing their department instead of a business as a whole. So behavior can shift, collaboration can really suffer, and suddenly everyone is defending their own numbers instead of solving company-wide issues. And I've seen this a lot. It's really unhelpful. I don't know if you've experienced this, but I certainly have. I was in quite a large business and we had 120 cost centers just because it was a retail store, so 120 retail stores. And then we also had the head office departments. And the amount of times during month end that we had managers coming to us and asking us to reallocate from one cost center to the other. Honestly, we could have spent 5 full days doing that reallocation. And if you really think about it, as a company as a whole, that is a huge amount of resources and it's not going to improve profitability. So having those kind of situations where people are just defending their numbers and just constantly want to reallocate to every other department is not helpful at all. It's obviously a fine balance. There is a situation where you might need to do a little bit of that, but in general, it's a habit or a behavior that you really don't want to be introducing. So the real benefits of having departmental cost center accounting when it's introduced at the right time can be generally useful. It gives you a better cost awareness. So as a business grows, fixed cost in particular can become harder to see. So cost centers make that easier to understand who is spending what and why, especially once headcount and supplier numbers increase. It gives you more informed planning. So when costs are clearly allocated, you can plan a bit better, particularly when you're then going through each cost center with the cost center owner. So as a business scales, there's a lot more complexity, or even if you're preparing for a fundraise, making sure that you've covered everything in a bit of detail and then rolling it all up to see the big picture is at times can be useful. And then profitability insight. So again, it can be quite powerful when applied to products or channels early on, knowing where margin is really coming from and helps focus limited cash and people in the right areas. The downsides and why finance teams often suffer is cost center accounting is not for free. It takes time and discipline. So as I mentioned, department cost centers in particular can add complexity and they require sophisticated systems and tighter processes. So month end can become bloated if controls aren't in place. So I've definitely seen, as I mentioned, finance teams spending way too much time reassigning invoices and journals only to produce reports that don't change any decisions. It's a total wasted effort. So if you go down this route, you do need to be quite strict. You need to set materiality thresholds. You need to get the coding right first time, limit late changes, and being clear on what data actually matters. So there's a real cultural risk if leaders only care about the departmental numbers, lose accountability for the overall P&L. And I cannot stress this enough. Cost center accounting should support better decisions and not encourage siloed thinking. So when should you introduce cost center accounting? I keep talking about the pros, and it doesn't sound like something you want to introduce. I would also just mention that if you're on a smaller system like QuickBooks and Xero, cost center accounting isn't amazing in both of these systems. So if you are still quite early stage and you are using one of those general ledgers, I would use the tracking codes that they have in Xero and QuickBooks for product and channel splits rather than cost center or departmental reporting. I would say that at the point that you're looking at an ERP or one of the bigger tech softwares, then that might be a good time to introduce cost center. It also shows that you're a bigger company, it's much more affordable. Hopefully you do have the right behaviors in place already, and that might be the good time to switch over to cost center accounting. If you're interested in finding out more about the finance tech stack that I recommend, I'll leave a link above and below. So I think putting the tech challenges aside, there isn't really a perfect moment, of course, to introduce cost center accounting, but there are some things worth considering. So if costs are generally spread amongst multiple areas, if you're really struggling to understand where the spend is increasing, the business has outgrown a simple P&L review and you need to see more of a matrix P&L, and your leadership is capable of interpreting the data responsibly, then this might be a good time to introduce cost center reporting. If you're still early stage, focus first on a clean core reporting, your product or channel margins, cash visibility, and that whole P&L ownership across the leadership team. If you can focus on that, you're doing really well and giving the insights that the leadership team needs. Once you've got that, then you can do a step change. So cost center accounting is really a tool. It's not a milestone. You don't need to rush to it, but it needs to be introduced at the right time because then it supports better decisions. But as I've mentioned, introduced too early and it creates complexity without value. So as with most things in finance leadership, judgment matters more than process. If you want to become a really strong finance leader in the next 12 months, then I've got a 3-step plan for you. The first one is to subscribe to this channel. So just click on the subscribe button below. I post a video like this one every single Thursday. The second one is to take a look at my book, Financial Leadership Fundamentals, How to Become a CFO in a Startup or Scale-Up, where it is a very practical book and you have a lot of actions that you can implement immediately in your role. And the third one is to take a look at the FLF, go through all of this information in a lot more detail, and we have live Q&A sessions with myself every single month. Thanks so much for watching, and I'll see you next week.